Welcome to today's episode, where we dive into a topic that resonates with so many of us: the dream of replacing your 9-to-5 job with passive income to live life on your terms. Imagine earning $70,000 a year without clocking into an office. Whether to travel the world, pursue a passion, or simply enjoy more freedom. A recent piece of content titled "Buy These 5 ETFs to Replace Your 9-to-5" outlines a strategy to achieve this through dividend-paying exchange-traded funds, ETFs. This isn't a get-rich-quick scheme. It's a disciplined, long-term approach that requires sacrifice, patience, and a clear understanding of the risks and rewards. Today, we'll break down this strategy, analyze its implications in the context of today's economy, and provide practical advice for investors looking to build a passive income stream. Let's explore the foundation, the market impact, sector-specific effects, and actionable steps to make this dream a reality. The foundation: understanding passive income and ETFs. The core idea is to generate enough passive income from investments to match or exceed your current salary, say $70,000 annually. Unlike active income from a job, passive income flows from investments like stocks or ETFs, primarily through dividends, cash payments from company profits, or capital appreciation, rising investment value. The content emphasizes ETFs, which are funds traded on stock exchanges, like stocks, but hold diversified portfolios of assets, dozens, hundreds, or even thousands of companies. This diversification reduces risk compared to investing in a single stock, like McDonald's, where bankruptcy could wipe out your investment. ETFs, by contrast, automatically adjust their holdings, spreading risk across many companies. To replace a $70,000 income, the math is sobering. At a 1% dividend yield, you'd need $7 million invested. At 4%, $1.75 million. At 10%, $700,000. These numbers seem daunting, but the strategy hinges on two key principles: consistent investing over time and the power of compounding. By regularly investing and reinvesting dividends, your portfolio grows not just from your contributions, but also from rising dividends and asset values. This isn't about having millions today. It's about building wealth over years or decades through disciplined saving and investing. Historically, dividend investing has been a cornerstone for wealth building. Since the 1920s, dividends have accounted for roughly 40% of the S&P 500's total return, with reinvested dividends significantly boosting long-term gains. In today's environment, with interest rates fluctuating and inflation cooling from its 2022 peak, dividend ETFs offer a compelling way to generate steady income while hedging against market volatility. However, risks remain. Market downturns, dividend cuts, or economic shocks can erode returns, as seen during the 2008 financial crisis when many firms slashed dividends. Market impact: dividend ETFs in today's economy. The broader economic context shapes the appeal of dividend ETFs. As of September 16, 2025, the U.S. economy faces challenges: rising national debt, with nearly $1 trillion in annual interest payments, persistent deficits, and potential Federal Reserve rate cuts. These factors influence ETF performance. Lower interest rates could reduce yields on interest-paying ETFs like Treasury ETFs, but they may boost stock valuations, benefiting dividend growth ETFs. Conversely, high debt levels raise concerns about long-term economic stability, potentially increasing market volatility. Globally, emerging markets, key components of international dividend ETFs, are experiencing uneven growth. Countries like India and parts of Southeast Asia show robust expansion, but geopolitical tensions and trade disruptions could impact multinational companies held in these ETFs. The U.S. market, while resilient, is not immune to corrections. The S&P 500 has climbed steadily since the 2020 COVID crash, but valuations are high, with price-to-earnings ratios above historical averages. Dividend ETFs, particularly those focused on stable, high-quality companies, offer a buffer against such volatility due to their focus on cash-generating firms. The content highlights 5 ETF categories: broad U.S. dividend ETFs, e.g., SCHD, VYM; international dividend ETFs, e.g., VYMI, SHI; dividend growth ETFs, e.g., Noble, REGI; real estate investment trust, REIT; ETFs, e.g., SCHH, MORT; and interest-paying treasury ETFs, e.g., SGOV, BII. Each serves a unique role in a portfolio, balancing yield, growth, and risk. For instance, SCHD and VYM, yielding 2.4% and 2.6% respectively, invest in stable U.S. firms with a history of dividend payments. International ETFs like VYMI, 4.1%, offer higher yields but greater risk due to currency fluctuations and geopolitical factors. REIT ETFs like WART, with a 12% yield, are tempting but volatile due to their exposure to mortgage debt, sector analysis, opportunities, and risks. Let's break down the sectors these ETFs target. 1. Broad U.S. Dividend ETFs, SCHD, VYM. These funds focus on large-cap U.S. companies across sectors like consumer staples, healthcare, and financials. These sectors are defensive, meaning they tend to perform well during economic downturns. For example, during the 2008 crisis, consumer staples firms like Procter & Gamble maintained dividends, while tech stocks faltered. However, if economic growth slows, even these stable sectors could face pressure, especially if consumer spending weakens. 2. International Dividend ETFs, VYMI, SHI. These ETFs invest in developed and emerging markets, offering exposure to sectors like energy, manufacturing, and technology in countries with growing economies. The higher yields, 3.9 to 4.1%, reflect risks like currency depreciation or political instability. For instance, European firms in VYMI may face challenges from energy price volatility, while emerging market firms could benefit from infrastructure booms. 3. Dividend Growth ETFs, NOBL, REGL. These target companies with a track record of increasing dividends, such as S&P 500 Dividend Aristocrats, NOBL, or mid-cap firms, REGL. Sectors like industrials and healthcare dominate here, offering growth potential with moderate risk. Mid-caps, in particular, outperformed large caps in the early 2000s recovery, suggesting upside in a post-recession environment. However, rising interest rates could pressure growth-oriented firms. 4. REIT ETFs, SCHH, MORT. Real estate ETFs are sensitive to interest rates and housing market dynamics. SCHH, focused on property-owning REITs, benefits from stable rental income but faces risks from office vacancies in a hybrid work era. MORT's 12% yield comes from mortgage-backed securities, which are highly sensitive to rate changes and defaults. The 2008 housing crisis showed how quickly mortgage REITs can plummet when credit markets tighten. 5. Interest-paying treasury ETFs, SGOV, BIL. These ETFs, backed by short-term U.S. Treasuries, are considered low-risk, offering yields tied to prevailing interest rates, currently around 4 to 5%. They're ideal for conservative investors, but offer no capital appreciation. If the Fed cuts rates in 2026, as some economists predict, yields could drop, reducing income potential. Investor advice: building your passive income strategy. For listeners looking to act on this strategy, here's practical advice. 1. Start early and be consistent. The content emphasizes always be buying. ABB. Set up automatic investments into ETFs weekly or monthly, regardless of market conditions. Historically, dollar cost averaging reduces the impact of market volatility. For example, investing $500 monthly at a 7% annual return could grow to $1 million in 30 years, assuming reinvested dividends. 2. Diversify across ETF types. Allocate funds across the 5 ETF categories to balance yield and risk. A sample portfolio might include 40% in broad U.S. ETFs, SCHD, VYM, 20% in international ETFs, VYMI, 20% in dividend growth ETFs, Noble, 10% in REITs, SCHH, and 10% in Treasury ETFs, SGOV. Adjust based on your risk tolerance and income needs. 3. Reinvest dividends. Enroll in a dividend reinvestment plan, RIP, to compound returns. For instance, reinvesting a 3% dividend yield on a $100,000 portfolio adds $3,000 annually, which buys more shares, increasing future dividends. Be mindful of taxes, as dividends are taxable even if reinvested. 4. Assess risk tolerance. High-yield ETFs like Mort are tempting but volatile. If you're risk-averse, prioritize Treasury ETFs or broad U.S. ETFs. Use tools like Morningstar or ETF.com to analyze fund holdings and historical performance. 5. Plan for the long term. Replacing a $70,000 income may take 10 to 30 years, depending on your savings rate. If you save $1,000 monthly and achieve a 5% yield plus 3% annual growth, you could reach $1.4 million in 20 years, generating $70,000 annually. Patience is key. 6. Monitor economic trends. Stay informed via resources like market briefs, mentioned in the content, to track interest rates, inflation, and global events. If rates fall, shift toward dividend growth ETFs. If volatility rises, lean on Treasury ETFs. Conclusion: a path to financial independence. Replacing your 9-to-5 with passive income is a marathon, not a sprint. Dividend ETFs offer a viable path by providing steady income and diversification, but success requires discipline, regular investing, and a willingness to weather market ups and downs. In today's economy, with high debt levels and potential rate shifts, these ETFs balance opportunity and stability. By starting early, diversifying wisely, and reinvesting dividends, you can build a portfolio that eventually funds your dream lifestyle, whether that's traveling the world or simply enjoying financial freedom. As always, do your due diligence, consult a financial advisor, and stay informed about market trends. Share this episode with someone who dreams of financial independence, and let's keep the conversation going. Until next time, invest smart and dream big.